we are trying to cover the macro development and current challenges in financial market today. This is actually what is reflected here. This is a Bloomberg screen. Bloomberg is the financial terminal all around the world used specifically in investment banking, asset management and wealth management firm. This is the ocean of the data and the news. You know, from the newspapers and news channels as well. Here, what this page specifically showing. This page is the world interest rate probability page and showing what is the probability of the Federal Reserve rate hike or rate cut process in the next couple of months and years. And today, at the top of the page, at the top right of the page, you will see the date today. So this screen is directly get the information and give specific information about the probability of rate hike and rate cut by the Federal Reserve government. And here, as you see, today, when we reflect this screen today, there is no rate hike probability by the Fed. What is the reason behind this? Because in the next couple of slides, you will see that Fed will be end up their rate hike process because they get the inflation under control after the rate hike, and because the interest rate increasing, demand decrease, inflation decrease, and the inflation, the actual inflation converging the Federal Reserve target level approximately 2%. Today it is at around 3%. So there will be no rate hike process by the market probability indicators, as you see here. This blue line showing what will be the implied rate, and this yellow bars showing what will be the number of rate cut and rate hike process. So at the left-hand side, you can see that today the current implied rate of the Federal Reserve government, what will be the cost of funding today? It is around 5.25, and it will be end up like this during this year. And the market saying that we will have, for instance, until the, let's say, the mid 2024, we will have around 3 times rate cut, and the actual rate will be around 4.6. So if you ask Dr. Kadir, what we will understand from this picture, you will understand from this picture this. Please look at the date here. What is the date here? December 4, today, right? December 4 today, showing the probability of rate hike and rate cut. So what I did how this map, probability and interest rate map, would be like approximately 6 months ago. And I get this picture. Here, as you see, I'm in June 2, 2023. And the map here is a little bit different. Look at this map and look at this map. This is the same market expectation, but different perspective. The market on June saying that Fed will increase the rate in the July approximately 0.5, and the rate will be around 5.25. Then Fed will wait. Then at the end of the year, they will start the rate cut process. So on June, the market expected until the end of year, we will experience another rate hike. Then the Federal Reserve start to decrease the interest rate. But now it is saying that there will be no rate hike anymore. The market expecting just the rate cut from the Federal Reserve government. This implication coming from this. Let's look at the slides in next couple of presentation, and you will understand what is the basic reason market was expecting a rate hike first, then the rate cut. But today, market is only expecting a rate cut process from the Federal Reserve Government, Fed. What is the reason behind this? The reason behind this is this. Please look at on the left-hand side. This is central bank policy rates, which is starting from the 2011 until today. And as you see in the picture, the blue line, light blue line showing to Australia, the black is the United States, the dark blue line is the Eurozone, the green is the UK, and the purple is Japan. And as you see, the highest one around 2011 is the Australian targeting rate. It's around 4.5%. And until the COVID process, it's converged around 1%. Then during the COVID crisis, as you see, all interest rates from the developed market central banks directly cut to the zero lower bound. So the first and the important question should be this. Dr. Kadir, what is the basic reason behind this picture and this graph? So why the developed market central banks decrease their interest rate to their zero lower bound during the COVID-19 process? What is the reason for this? The reason for this is this. When we face a shock, a crisis, a financial market demand side or supply side shock or crisis, any type of demand will stop there. Nobody going outside, nobody creating demand, nobody buying something new, and the prices start to decrease. But as you know, inflation is not good. Deflation is not good as well. So if the inflation is above the targeted level, this is not good. But inflation is below the targeted level, this is not good as well. So if the price level started to decrease, central banks, not just to keep the rights of the consumer, they will also keep the rights of the producer as well. And if you are producer and the price is decreasing, this is good for consumer, but this is not good for producer, right? You are producing something and the price is decreasing. Consumer benefit from this opportunity, but the producer is not. Because you produce a goods and services with some cost, and your cost, let's say $100, and today the market price is decreasing around $90. So you will lose from this opportunity, right, as a producer. For that reason, central banks intervene in the market and to recover the market demand and supply condition in an equilibrium level, they started to decreasing the interest rate. So after the interest rate cut, after the interest rate decrease, the market started to increase their demand. As you see here, even Federal Reserve, even Royal Bank of Australia, even Bank of England, even the European Central Bank, even the Bank of Japan, all the developed market central banks during the COVID crisis decreasing their interest rate to their zero lower bound. Okay, so after you decrease the interest rate, Dr. Walchin, Auntie Danielle, Victoria, Gabriel, all people here started to increase their demand, because if you borrow from the market, the cost now is below the pre-COVID level. Okay, for instance, you are borrowing a money from the bank, from your friend, from any type of people or institution, the cost of borrowing today decreasing. So let's think this. If you trying to buy a house or car from the market, before the COVID process, the bank, when you go to a mortgage loan or a vehicle loan, okay, the bank offering you, let's say 5% interest rate. And you are saying that if I get $1 million for a mortgage loan, in 10 years, I will pay approximately $800 interest rate. And this is $800,000. This is high for me. But when the interest rate decreasing, now your $1 million, you will pay 500,000 interest expense for this borrowing cost. and you think that now the cost is cheaper, and then you decided to buy this type of housing, this type of cars and vehicles, and market demand started to increase. If the market demand started to increase, then the price, the inflation started to increase as well. The main argument, main objective here, the inflation is going down. So to bring the inflation to the pre-COVID level, the basic solution is to decrease the interest rate and to trigger the market demand. Then, when the inflation started to increase and come to the target band of the central banks, what we mean by target band? Each central bank has a target band for their interest rate and for their inflation output level. We calculate these type of dynamics from the Taylor rule, and Taylor rule showing that how the interest rate can be adjusted if the inflation, if the output, and if the exchange rate deviate from the targeted level. So if I have, let's say, 2% target of the inflation, and during the COVID crisis, if the inflation level decreased to the 1% level, I need to increase the inflation to the 2% level again. So I'm decreasing the interest rate. Then after the inflation started to rise, then there is no need to decrease the interest rate anymore. Then I can start to increase the interest rate like here. Okay. All developed market central banks started to increase their interest rate after the COVID crisis when the inflation come to their targeted band. And in the right-hand side, please look at this one. This right-hand side showing the market expectation for the central bank. This graph is exactly same to this probability map. Actually, this is exactly same with this probability map. But this is directly widespread from June 2022 until today. But here, as you see, I'm taking just a specific date like June 2023, and here, as you see, December 4, 2023. But here we have a time series, and let's say for the Eurozone, if I look at the picture, what will be the targeted interest rate in the, let's say in the mid 2022, it will be like around 1%. But if I look at the Eurozone map at the March 2023, it will be around 3.5. Okay, for the United States, let's say, in the June 2022, the target market expectation is 3.5, but when I come to the 2023 March, it will be around 5.5. So from here to here, the basic dynamics behind the market expectation is the inflation in the next couple of years will be higher than today, and the central bank will be increase their interest rate to decrease the inflation. The basic dynamics of the financial market is adjusting between the inflation and interest rate is like this. So when I look at the central bank interest rate, as you see here, another picture directly converting those probability math into this style is change in central bank policy rates. This is showing directly. Please look at the picture. Let me adjust my screen again. Here, as you see, the left-hand side is 250, 200, or 150, showing the rate hike, and this is basis point. Okay, please don't think this is actual number. This is basis point. And as you see, this black and gray line are the developed market interest rate hike and the rate cut, and this dark and light blue are the emerging market. And as you see, the rate hike and rate cut basis point is smaller in developed market, but higher in the emerging market, because we have risk premium in emerging market, we have higher risk, higher capital flow in the emerging market. For that reason, in any type of inflation or demand and supply side shock, the volatility in interest rate is higher in emerging market than in developed market as well. You should keep this information in this style. The emerging market has a risk premium because they have volatile market, they have risky asset. For instance, if I put my money, let's say in China or let's say in Indonesia, rather than to put my money in Germany, but Germany is a stable country. If I bring $100 million in Indonesia, and if there is a political crisis in Indonesia, I can't get my money back. But in Germany, I couldn't face such type of a problem. Also, the borrowing cost and CDS indicator like credit default swap, risk premium indicator for Indonesia is really high when we compare it with Germany. For that reason, the interest rate hike and cut process for the Germany is a little bit less volatile when we compare with the emerging market. On the right-hand side, in the reverse side, the expectation for the interest rate is this. Expected policy rate at the end of third quarter of 2023. What we mean by this? September 2023, this year, 2 months ago, the market expecting the inflation and the expectation for the policy rate will be around here. Please look at this. Current interest rate is the light blue. The purple is the rate as a start of 2022, and the dark blue is the expected rate for the targeted date, third quarter of 2023. And as you see, let's look at, for instance, United States. The United States expectation is around 5, but let's say for the India, the market expectation for the policy rate is around 7%, but let's look at Japan, it is around just 0. Because Japan is always struggling with the deflationary process during the last 20 years. So the main problem for Japan is even they couldn't create inflation. Their domestic demand is really low, and their international current account surplus is really high. Because Japan is exporting more than they are importing, they couldn't create any type of inflation because the demand from the rest of the world for the Japanese good is really high. They are creating innovation, they are creating the value addition. For that reason, they couldn't create any type of inflation, even they want. For that reason, Japan inflation and the policy rate is just around 0, while it is for Philippines, Indonesia, or India is around just 6 and 7%. And as you see here, maybe some of the attendees, if they participate our class in the previous week, you know that during the COVID crisis, because we decreased the interest rate here during this process, what the central bank did? Central bank did this. They decreased the interest rate for the zero lower bound. They started to asset based and mortgage-based securities quantitative easing period, meaning that the central banks buy the asset-backed and mortgage-backed securities from the market, give the huge liquidity to the market, and their balance sheet started to increase during this rate cut and quantitative easing period. After the quantitative tapering, meaning vice versa of the quantitative easing, during quantitative easing, we are buying mortgage and asset-backed securities from the market. During the quantitative tapering, we are selling all those bonds and bills and taking our money back. Quantitative tapering is this. Quantitative easing is the reverse action for that. And as you see, during the COVID crisis and during the quantitative easing period, the central bank balance sheet for the just United States is around $9 trillion, and it is rise from just $4 trillion to the year, meaning that approximately Fed balance sheet increased $5 trillion during the COVID process, meaning that Fed gives $5 trillion cheap money with zero cost to the market. And during those periods, people get those $5 trillion with really, really low cost, buy houses, buy vehicles, by their needs, and inflation started to increase. And after the inflation come to the targeted band of the Federal Reserve, then they started to sell those bills and bonds from the asset-backed and mortgage-backed securities. Then the central bank balance sheet started to decrease because they are selling those bills and bonds and they are calling their United States dollar back to the Fed. And as you see here, we are comparing other central banks' balance sheet as well. The blue one, the light blue one is the New Zealand, the black is Australia, purple is Eurozone, green is United States, and the dark blue is the United Kingdom. As you see here, Eurozone central bank balance sheet reached to the level is approximately 70% of their GDP. This is a huge money, meaning that you are giving cheaper liquidity to the market, which is approximately 70% of your gross domestic product. Excellent and huge amount of money. For that reason, after the COVID process, the inflation all around the world increased hugely because we have lots of money at our hand and that money is really cheap cost. As you see here, Eurozone is the highest balance sheet compared to their GDP, and the New Zealand and the Australia is the lowest one. Their balance sheet is just around 25% of their GDP. So the inflation is a little bit more controllable in New Zealand and Australia compared to the rest of the world because they don't give huge cheap money to the market, and inflation does not go to the out of control zone for those economies. And as you see here, I have the real market indicators for the United States, gross domestic product, GDP, and the inflation. And this is approximately 60 years time series of the real GDP of the United States, which is average of the 2.7% for each year growth, GDP growing average 2.7% during these 60 years. And today, currently, it is around just 0.9 at the end of the fourth quarter of 2022. And here, as you see, the CPI, core CPI is the black, and the light blue is the headline CPI. And the headline CPI reached approximately 9% after the COVID crisis. This is a huge increase in inflation for the United States because their targeted level is here, 2%. And the central bank should bring this inflation to this targeted band period. So this is an impossible, first, when we look at the market indicators, to decrease the inflation from 9% to the targeted level of 2%, in the first perception is impossible. But Fed take the decisive action, huge measures to bring the inflation to the targeted level of the 2% and give a huge increase in the interest rate during the quantitative tapering period. And today, approximately from 3% to the 5% interest rate increase, decrease this inflation to here. Look at this. Inflation is here, but until the January 24, the inflation will come around the 3% with the Fed forecast period. This means this: I'm here, I'm increasing the interest rate, and my inflation will decrease from here to here because the cost of money will be higher. Nobody will consume any money. Nobody will create any demand. Nobody go to the buy house or loans, and the prices for those house and loans and cars will start to decrease, and inflation will converge to our targeted band. As you see here, this is most important picture, I think, in the slides. if you look at this picture, you can see that inflation component, this means that what will bring the inflation in the United States in year-over-year percentage change during the COVID crisis and today. And I'm here. Let's choose this one, for instance. Let's choose this bar. In this bar, as you see, the black is sheltering, like housing. And the light blue is services x shelter, meaning that any type of services. And the core goods, basic goods, is the purple line. And the green is the food. And the energy is the blue line. And now please look at this picture. From here, energy, the dark blue, is just here, even less than of half of 2 years ago. So energy prices decreasing all around the world because energy prices first rise up because of the quantitative easing, and the second, Russian-Ukraine conflict. For that reason, natural gas and oil prices approximately increased 200% during the Russian-Ukraine conflict, and the energy contribution to the inflation really rise. But today, because the conflict solved, because the interest rate high, the energy contribution is really low. But the main problem is today is coming from the food prices. Food prices around the world still high. But the biggest problem is coming from the shelter and the services sector. All around the world, rent and mortgage credits and the buying house is really high today. And the most important contribution, I think, is the services excluding shelter. What we mean by this? Any type of services, prices are a little bit sticky. For instance, let's say Dr. Walchin get an increase in their weight because of the inflation. Let's say 5%. After the inflation going down, nobody will ask to the Dr. Walchin that because inflation decreasing, let's decrease your wage. No, this is not the way in the employment market. Even the inflation decrease, your wage will be still high. For that reason, services prices will be still high. Today, the main problem to dealing with of all these type of problem, contribution of the inflation problem, the biggest one is coming from the services sector, not the food, not the energy, because those inflation are transitory. They will have the short-term and temporary effect on the overall inflation. But the services sector will contribute with a sticky performance during the even 2024 for the inflation overall performance. And here, the market challenges for the United States labor market. What I have here, unemployment rate. As you see, the historical time high for the unemployment rate I have. Approximately 15% unemployment for the United States. This is not sustainable because United States target is around 4.5% for the unemployment rate. So to decrease the unemployment, to increase the inflation, we know what the Fed did. They decrease the interest rate and they create the inflation and they decrease the unemployment rate as well. And as you see here, labor market supply and demand condition during the COVID crisis has a shrink here. But then after the quantitative easing period and necessary measures taken by the Federal Reserve, they reach pre-COVID level better performance. For instance, in the pre-COVID level, even we have 1.2%, but here, as you see, I even get the 2% as well. And this picture is summarizing for the United States of America, the today current challenges. Please look at this one. The real GDP. Last observation for the third quarter of 23 is 5.2. And in 2023 overall, I will have a real GDP growth around 2.5%. But for the 2024, 1 year later, my GDP growth will decrease. And for this reason, all around the world, we are speaking the recession. If the GDP decrease for the consecutive 2 quarters, I can directly speak about the recessionary effect of the market expectation. So the real GDP today will be growth around 2.5%, but for the next year, it will be half, 1.2. So the market still not get rid of all recession expectation. Market still fearing about the recession. And the CPI, as you see in 2023, 2022, the 8% consumer price inflation I had, but today it is 4.1, just half of it. And in next year, it will be just 2.7. So Fed solved the inflation problem because inflation from 9% come back to the 2% targeted level. But what is the main challenge at my hand today? The GDP also decreasing. And this is a recessionary signal for the market. I don't want this. While decreasing inflation, I don't want to create a recession in the market. And unemployment rate, as you see here, it is around just 3.5%. But next year, it will be around 4.5 because of the GDP shrink, because the recession can be come from the market, lots of factories can be closed down, collapsed, and the unemployment can be increased at the next couple of years as well. As you see here, this is a summary of the current challenges and the financial market implication of the United States. Let's take a look at the Eurozone. This is the Eurozone GDP and inflation. And as you see here, I have real GDP growth approximately for 15 years for the Eurozone, the black line showing the real GDP growth. And I have approximately 2% of real GDP growth, but during the COVID crisis, the GDP shrink more than 12%. But after the ECB start to quantitative easing and take the necessary action for the COVID crisis, the GDP growth come back to the stationary process of 15 years average. And today, I have at the level what I want. But the domestic demand, as you see, and the net export is a little bit in different side. For instance, Eurozone is a production economy, and they are the next exporter, net exporter for the rest of the world. But today, net export of the Eurozone is a little bit in the minus zone. And Eurozone also speaking about the recession because they are not producing. The rest of the world does not buying their goods and services, and net export is decreasing for the Eurozone economies as well. And the inflation for the Eurozone, as you see, during the COVID crisis, I'm coming here because the European Central Bank inflation target is 2%. They are really good to fight with the inflation. But after the demand and supply side of the shock of the COVID crisis, the inflation come to the 10%. But today, for the Eurozone economies, I will come back the Eurozone inflation to the 3% again in just next couple of 3 months. Eurozone economic activity, as you see, export and industrial production, as you see, export is shrinking and industrial production is shrinking during the 2022. For that reason, as I say, the fear of the recession in Eurozone economy is still at hand. All factories, all economic and market makers are still thinking about if the interest rate will be stay at this level, the market will go into the recessionary cycle in the next couple of years. For that reason, Eurozone economies and the rate cut and rate hike probability also changes. I didn't reflect the Eurozone rate hike and rate cut probabilities, but the market today is expecting from the ECB, the European Central Bank, at the end of March of 2024, a rate cut for approximately 1% during until second quarter and third quarter of the 2022. Because Eurozone economies can also go into the recession, and to not go into the recessionary cycle, ECB will start to decrease the interest rate. And here, there are another real market indicators, the retail sales and the consumer confidence for the Eurozone economies. As you see, I have an increasing consumer confidence. The Eurozone consumer market participant expecting Eurozone economy will recover in the next couple of years, but the retail sales saying the reverse. I'm not creating any type of retail sales, even in the domestic economy or even to the rest of the world. And here you can see one of the best representative of the European central bank and Eurozone economies, the Germany. As you see here, the Eurozone real GDP for the Germany is minus the recession. And it will be for the overall 2023, it will be around minus 0.2. But in the next year, it will be positive. So the market saying that if you decrease your interest rate during the 2024, then you can create a positive real GDP growth. And the CPI, as you see here, previous year is around 8.5%, and today is 6.5%, and the next year it will be just half, 2.7%. It is really close to the target band of the Bundesbank. And unemployment, it will be around 5.7% stable, good. And the China, the last and the biggest economy, I think, today, and until the 2030, it will be the biggest economy in the world with the gross domestic product calculation process. And as you see here, the China GDP and inflation, China is a little bit different from the developed market. Why? China is the motorcycle of the world gross domestic product. When the world creating 2% of gross domestic product increase, the China creating approximately 7%. Meaning that, let's think this, Argentina is just around $1 trillion economy, and the China is around $15 trillion economy, and each year China growing 7%, meaning that $1 trillion additional gross domestic product they are producing. So in each year, China growing more than whole economy of the Argentina. This is huge, and this is marvelous economy. For that reason, as you see, the orange line here showing the real GDP process for the Chinese economy, and the black bar showing the consumption, the dark blue is the investment, and the next export. Even during the COVID process, there is no shrink for the Chinese economy. Please look at this picture. Eurozone, minus, shrinking. Go to the United States. I have the United States here as well. Look at this one. And look at this one. Economy is shrinking. But for the China, there is no shrink. They are still producing positive gross domestic product. China does not shrink. China does not go into the recession during the COVID process. It is out of the world. They are something different. China is something different in economic indicators when we are comparing them with the rest of the world. And the inflation for China on the right-hand side, please look at this one as well. I have year-over-year inflation, and as you see during the COVID process, the producer price inflation converged to 12%, but the consumer price is still low, just 3%. Why the producer price is increasing? Because the supply chain broken, there is no cost, there is no possibility to bring the ships from Shanghai to California, because all people locked down, all economies locked down, and the shipment cost is really increasing. So producer prices inflation will rise, but the consumer price inflation is still under the control. It is just around 3%. And the China, this fixed asset investment for the cyclical indicators, this is year over year, approximately 12 years covering from the 2011 until today, and the fixed asset investment because of the COVID crisis decreased, but it easily recovered for the Chinese economy, and still around today, the 10 years average level, exactly converging to the 10 years average. So when we compare China, United States, and Eurozone with their performance to fight with the COVID economic crisis, China is one of the best performers because they are production economy and they are the center of the production for all around the world. They can create inflation easily if they want, but they don't. So in any type of cyclical indicators, China is one of the best performers. And the consumer confidence, as you see here, during the COVID crisis, consumer confidence does not decreasing. But because China does not open fully after the COVID crisis, consumer confidence from the 120 levels decreased to the 90. This is a shock for the Chinese economy as well, because here the COVID passed. But the problem is China does not reopen their economies as fully and not adjusted all their capacity to full of production. For that reason, they are producing less than their potential and the consumer confidence decreasing during this period. And here, China financial dynamics, and here I have Chinese yuan, and this is one of the exchange rate war of the world, because China willingly decreasing their interest rate, depreciating their interest rate against United States dollar, because China is a net exporter. If I am a net exporter to the rest of the world, I want to depreciate my country's exchange rate. But if I'm net importer and I'm importing more than I'm exporting, I will lose if I depreciate my currency. My currency should appreciate. And here, the K policy rate for the Chinese economy here, medium-term lending facility is the orange line. It's just around 3%. They will never hide their medium-term lending facility to 5%, for instance. But the interbank rate for the black line is just around 2%, and the loan prime rate for the 5-year even less than 5%. So Chinese economy never rate hike process into the rate hike process until the 5%. They are still less than 5% because their inflation outlook is better performing when we compare it with the United States and the Eurozone. For that reason, they don't need to increase their interest rate to fight with the inflation aggressively. And the last slide for the Chinese economy, here I have a summary for the China, and this is the big picture for the China. As you see, the real GDP is just 3%, really less than their 20 years average. It is around 6%, but the economy converging to market indicators for 5.2% for this year, but next year it is around still 4.5% and less than their average. And the consumer price inflation is under control, even less than 2%. But the unemployment is really increasing, and this is not sustainable for Chinese economy. They should find a way to deal with this unemployment, because inflation is under control, but the unemployment is not. It is still increasing. This is the end of my slides.